You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Always good to be with you and with our listeners.
What's new from the land of the bamboo curtain, China?
The bamboo curtain. I bet you there'll be a number of markets and the economies wishing that the bamboo curtain was effective. But, you know, we had at the whole year until June for the Shanghai Stock Exchange was wonderful. A huge rally, lots of new accounts opening up, new issues like you wouldn't believe, hugely oversubscribed. So in that regard, it was like any of the great new issue markets in history, whether you want to talk about the South Sea Bubble in 1720 or New York in 1929 and then a number since. So these were definitely markings of terrific speculation, which can't be sustained. And in our work, we had the technicals on the Shanghai peak in 2007, and we needed to have 3 clusters of upside exhaustion readings, and the third one was just 1 week on it, but that was, you know, more or less as it was peaking in, was it June the 12th? So then it cracked really hard. We had a target, the 200-day exponential moving average, and it fell a little further to the 200-day ordinary moving average, and then the rebound. So what we've done here is compared, had a plot on the Dow in 29, the Nikkei in 1989, and gold in 1980. These speculations have similar characteristics, and on the conclusion, and then on the first crack, they're quite similar, and then on the rebound. So we had the rebound on the Shanghai SSEC out to this week, i.e., I think it was 21st to 24th, and then getting up to around 4,200, it made it to 4120 or something like that. So we had the timing window target, and we had the price target. So those have been met, but also we have a momentum indicator, CCI, and it was supposed to get up to a certain level, and it got there on yesterday's close. So the requirements for the rebound out of the initial hit that ends the bubble is now done. So we now see the China Shanghai heading south, and in the past can guide and like back in 1929, London was the senior market, and New York, although it was big, was you could call it the junior market or adolescent market. And when it started to go wrong in 1929, those problems fed into the senior market in London. So this is probably what will happen here. You're getting other things out of China too. Their container shipping index from their ports in Shanghai to Rotterdam have been in a trading range for 2 years, between 1,100 and 900, and then in the last 3 months it's fallen down to 550. So that's kind of like a real number. So it's not a pretty sight out there. And it will feed into the markets in London and New York and Europe, the problems in Shanghai. But then we should look at the New York market on its own just to make sure what's going on. And we had that some of the more speculative sectors within the U.S. market could peak on enthusiasms in the traditional period in May and June. And the S&P could set a high there and then correct a bit and then turn around a bit and then try for a high in early September, but you had highs come in early. And then quickly changing in here now, you've got the depth of the market or the breadth of the market between advanced declines, and you've got the number of companies, 52-week ups and 52-week lows, and it's deteriorating very quickly. So it became vulnerable, and it is now deteriorating technically very quickly. So whether we get a new high for the S&P into end of August, early September, who knows? But the market is fully expressed here, the enthusiasms, everything. So, but you've got some pretty bold statements out there. saw one the other day from one of the big banks in the U.S. that their reasoning was that because it has been such a slow or weak recovery, that therefore it would run longer. I mean, because you had a slow expansion, it's going to make it run longer? I don't think so. And then you've got one that I really laughed about. Bank of America came out with an argument saying, why would people suddenly wake up one morning and decide to panic? Well, you know, a panic isn't a decision. It's not a voluntary thing. It happens because everybody gets leveraged. The price stops going up. The more astute traders get out, and then the downtick, all of a sudden you're offside and you got Mr. Margin there. But, you know, they're all the same, these huge speculative markets. So that, and then also in the financial markets, you have the credit spreads, which we have hammered on, the difference between high yield bonds and low, you know, good credits. So higher credit ratings and lower credit ratings. Well, they narrowed into May. Part of that is a seasonal move, but before that, it was pretty speculative in spread products and lower grade stuff. So then it started to turn, and as we've been charting it, this turn is similar to the reversal in credit markets in 1998, where it started to reverse in June and really started to go in July. That one set up the collapse of long-term capital management, which I think $4.5 billion then was the biggest collapse at that time. But they were overly long spread products. Then you had, in 2007, the first early warning on developing problems in the credit markets. Was when that spread started to reversed and started to widen in that June. And then in 2008, same thing, and that then really pushed off the liquidity problems. So, but the interesting thing is, you know, Jim, that the first on the 98, 2007, 2008, the widening of spreads, and put it on a chart so it goes up, made a key breakout early in July of each of those years. Then turned around a bit, and then late in July or early August, then made the more dramatic breakout that sort of said, hey, here's trouble, guys. And it's the same thing's happening right now. We had the key breakout earlier in July, and then the other part would be a more dramatic breakout on the chart later in July, and it's happening here the last couple of days. So who's to say? But it looks like we're getting the same turn in credit spreads as in 2008, 2007, and in 1998. So the spread market is providing us with a very good indicator here, and that indicator is saying, watch out. So
we'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, with the price of gold going down, is that more of a currency play, or is that actually the price of gold?
Oh, yeah. On top of it all, currency, because the U.S. dollar has been firming, and you've got the main paradigm for the gold bugs has been the Federal Reserve is evil and it's going to depreciate the dollar forever and gold is going to go up forever. But that has not been happening. As a matter of fact, since 2011, gold has been coming down. So let's call it the old paradigm, and mainly the dollar going up. But you also have the other problem, which is commodities. Most, if not all of them, have been in a distinctive bear market since 2011. And now that's really making headlines about how bad it is. And but, you know, on commodities, we had we have a thing called a momentum peak forecaster, and it doesn't give signals often, but when it does, watch out. But it gave a huge signal in 2011, which we took to be the start, the call for the bear market in commodities and the bear market in precious metals. So, and it continues. Now, on the commodities here, like base metals, in the rallies in 2000 up to 2008 and then again to 2011, we took the real price, like the nominal price, and divided by the producer price index, so you can call it a real price. And they got 100 years of data on that one, and they took the biggest percent increase on record, at least in that 100-year record. And then you had in the 1920 and 29, you had a really good increase in the real price of base metals, but this one was magnitudes greater. And it stayed up there for a long time. So what that means is there was huge capacity built of mines, base metal mines, huge. So this is the problem. Plenty of supply. And the other part of the problem was you had not just a boom going on in China and an innovation of swinging over to a more free market system, but you also had the government in on doing intrusive things, artificial things, like building whole towns and factory towns that weren't required because they figured the growth rate was going to continue. So anyways, I think there's going to be many years of bear market in basic commodities, but gold is more interesting. It's getting the last of the old paradigm out. You have to get the people who condemn the Fed and say the dollar is going to go down. That theory hasn't been working, and they have to get fully out before you can look at the new paradigm. The new paradigm will be that the price of gold will be firm relative to all other commodities, and that also means wages and mining costs and everything else. So then that's where, in a post-bubble deflation, gold then becomes the premier industry because it's the one place that's making money. So we do have commodities falling faster than the price of bullion, and at some point that'll hook up where it'll begin to show up in profit margins of the mines that are still mining. Now the other thing here is you have the opposite thing where you've had senior index in New York still rising, and you've got the washout in the gold and precious metals sector. So who knows, maybe the next week or so, the decline in gold and the decline in gold stocks may give us what we need, which would be a downside capitulation. And we should go back to 2011 when we were getting upside exhaustions in a number of these things. So we're getting close to getting downside capitulations in bullion and some of the leading gold stocks. But it may take a number of readings on this, moving, daily plus weekly. We'll just see how it works out. So theoretically, you could be having a low in here for gold as various stock markets are making their high. That makes sense. And then you're going to have the stock market heading down, and then because there's not much liquidity in any instruments these days, but gold would still be the more favorable liquidity. So you could see the investment demand for gold going up as the storm comes in, and that could stabilize it, maybe even rally it in dollar terms. But then you have the problem of gold stocks in a heavy bear market for general stock market. Don't know how they'll do, but we look back to the top of the market in 2000 in that tech bubble, and the bank stocks were being dumped in order to buy the tech stocks. And then once the tech stocks blew out in March, then the bank stocks rallied. So this is just an outside guess, but there is a probability that some gold stocks could rally like the bank stocks did after the 2000 crash. I don't know. It's just a guess there, Jim. But we're looking for sunshine where we can.
Bob, thank you very much for chatting with us.
Always good.
Have a great weekend. My guest has been Bob Hoye, market historian. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.